What is good, everybody? This is Keith here today, and I wanted to jump on and create another video, a new video sharing something that I suppose again is of value and could help you as a trader on your journey to becoming consistent and profitable. And again, this relates back to another video that I uploaded, which is around the DXY and how important it is in terms of trading, especially for Forex, and how I use this to capitalize on what way the market is likely to go. So I'm just going to show you guys real quickly how I use the DXY and how I use key levels to capitalize and know which way the market is likely to go and which level it's likely to go to next. So then I can predict which way I can flow with the market. So I'll just jump on to my charts and I'll show you guys exactly what I'm talking about. So you can see, so as you can see guys, I have my charts up here on the right side and I have the DXY up at the minute. So basically what I'm looking at here is I used, as you can see, I have my time frames up. I have the 30-minute, the 15, the 5, the 3 and the 1. I rarely use the lower times like the 3 and the 1 minute. I mainly use the 15 and the 30 minute to get a scope of what way the market is likely to go, and I look at my key levels and then predict price from there on. And that's it. Keep things really simple and just, again, follow price action, follow my key levels and just trade off of that. And the other thing that I emphasize and I continue to emphasize is the importance of understanding the times that you're trading. So for example, it's like, what time are we now? 9:10 at night, 9 p.m. where I am here in Ireland. So the markets are going to be a little less active, a little less volatile at the moment. They're going to be just a little bit more corrective. So it's mainly coming into the morning time, like the London session for me, it's like 7, 8, 9 a.m. and then through to lunchtime, and then the New York session, which is mainly where the main volumes and volatility come in. And in the London session and the New York session, so around New York is 2:30, 3 p.m. So these are the key times that you want to be paying attention to, these key levels. So as you can see guys, I have the DXY up here on the 30-minute chart, and I have my key pairs that I look at, which is Aussie dollar, pound dollar, euro dollar, Kiwi dollar and euro yen. And one thing that I hope you guys can notice here is that most of these, except for the last one here, are all dollar related. And the DXY, like I said in my last video, the DXY is the dollar index. So this is the performance of the dollar. It's the performance of the dollar, how it's performing overall, if it's bullish, if it's bearish, and so on and so forth. So for example, as I said in my last video, if the DXY is bullish, then you will likely see these pairs here on your right hand side being bearish. If the DXY is bearish, meaning that it's going down, if the DXY is bearish, then you'll likely see these pairs on your right hand side being bullish, going to the upside. And this can fluctuate. Sometimes it can differ throughout the day. Like today, for example, you can see, look at these moves. Like today was pretty volatile. It was very volatile today. So for example, you can see here on the 30th, which is today, and tomorrow will be obviously the 1st of December. So today, London session, we started pushing down. So what I want to just show you guys, and what I find really helpful and really useful, is the key levels. So I find it is particularly more useful on the DXY, because then that just gives you an indication of where price is likely to move to next. So then you can say, okay, well, if his price is going to move to this area next, that'll mean that price is going to be bullish. If price is going to move to this area next, then price is going to be bearish. So then you can correlate that with the other pairs. So for example, at the moment here, we can see that price is currently trading around 95.87.3. Okay, that means that price is close to 96, but it's pushing to the downside at the moment. You can see price is currently pushing to the downside. Or the past few hours, it's been pushing to the downside on the dollar index. And if price continues to push down, then it will likely come to the next key level, which is 95.5. 95,500. Alright? So the reason for this is because this is how price moves. This is how price likes to behave. It goes, it's psychological that price will stop off at key levels and half levels. So like fives, halves, and then full levels like 96, 97, 95, 96.5, 95.5, 97.5, and so on and so forth. And that's why, like I said, there's possibility that price can, if price is going to only do maybe like two things. It's either going to correct here at 96, so it'll push back up, correct around 96, take a pump up to 96.5, or else it'll correct around 96, and then start pushing down to 95.500. That's it. There's no other, like, if you go back and you can see past data, you can see it does the exact same thing. You can see here, we're basically at 96.5, and again, look at the key times, it's 3 o'clock. We get those nice bearish candles around 3 o'clock, and then price starts to swim south. Okay, and then look, here is like 7 p.m, and price completes its course and goes straight to 96. Same here. Price basically creates a nice bullish engulfing candle here and starts pushing up. Then creates a nice flag pattern here. And again, that key time, which is London session, around here, we can see price is bullish, creating bullish engulfing candles. And the same thing around the New York session, which is around 2:30, and then completes its course and moves straight up to 96.5. Okay, so that's why I'm saying pay attention to these key levels, because they will paint the picture of where price is likely to head. And once you know if price is going to be bullish or bearish based on those key levels, well, then you can predict where price is going to go on your pairs, which is for me is Aussie dollar, Euro dollar, pound dollar, Kiwi dollar, and the last one, which is Euro yen, which moves pretty similar to these as well. So, like I said, just pay attention to these. You got to go back and actually do it on the charts to see what I'm talking about. There's no point in just watching the video and just not actually applying it yourself. You need to watch the video and then go and deploy it. Just go and plot on those key levels, 96.5, 96, 95.5. Go back even a lot further. Go back like months. Go back into like September, and just see the exact same stuff. Like you can see here, I've got 94 drawn up, 93. The exact same stuff happens when price gets to these key levels. We can see here, price has been overall bullish in an upward trend. We can see here, look, it gets to 93.5 right there. Okay, at 2 o'clock in the morning. Okay. Now, obviously, a lot of people who would be trading, probably, like if they're waiting for the London session to open, they're not going to be getting in straight away unless they have an order set to tag them straight in at these key areas. They're probably not going to get in at these key areas. So what you would likely do is, obviously, you wake up probably around 6 a.m. You come and you see, okay, right, price is after coming to this level, 93.5. It continues to push down, push down, push down. 6 o'clock, it's continuing to push down, Okay, right, I'm going to get in here. Right, price is pushing down. So then if price is pushing down here, well, then we're going long on these pairs, Aussie dollar, pound dollar, Euro dollar, Kiwi dollar. I'm just going to show you, just to prove what I'm talking about. So you can see that price on the 23rd of September, at the London session, which is 8 a.m, was pushing down. So we're going to be looking for price to be pushing up on the other pairs, which is Euro dollar, pound dollar, Kiwi dollar, those type of pairs. So again, we're looking at the, okay, so it's actually, yeah, 23rd of September. Okay, so take euro dollar for example, and then we go back, right? We're gonna have to go back a little bit further. So we can see so you can see that my chart is blank at the moment, so I haven't got a clue. But my predictions based on the DXY is that price is going to be bullish because the DXY is going down. Okay, and again, I'm looking at that key time, which is the London session. So again, I'm looking at the 23rd of September, and I'm looking at the London session, which is 7, 8, 9 a.m. Okay, and you can see on the bottom of my chart here, I have the 23rd of September, 7, 8, 9 a.m. Now I haven't actually checked this. I haven't did this before. I haven't looked at this before creating this video. This is the first time that I'm looking at it. And straight away you can see the price was bullish. So it's that simple, guys. It's really that simple. It's really that simple. And to no surprise is it was bullish because it hit a key level, right? But the point that I'm trying to make is that once you correlate these things, you combine these things, then you can make an overall prediction of where price is likely to go, and then you can decide, make a calculated decision based on that information. But again, it's about being disciplined to actually stick to it and follow it through. That's the hard part. That's what I have found challenging in my journey, and I'm just being completely honest. It's being disciplined and sticking to your plan when you're supposed to stick to that plan. Like for example, if you're saying you're going to trade and you know from experience that price moves at the London session 7, 8, 9 a.m, well then you got to stick to that. You got to only trade at those times. If you're trading at, for example, now 9 o'clock at night, 9, 10 p.m, 11 p.m, 12 p.m, well then you're not sticking to your plan. So therefore, how can you expect to get those consistent results that you're looking for? You have to stick to something that's actually proven to work to be consistently profitable. And like I said, with the DXY, you guys seen that the DXY pushed down. Okay, the DXY pushed down on the 23rd of September. Okay, this was pushing. This meant the price of the dollar overall was going down. So that means that we're going to be buying the pound dollar, the euro dollar, the Kiwi dollar, and so on and so forth at that key time, which is the London session. And as you can see, price played out perfectly, and you could have bagged yourself probably 20, 50 odd pips. You can see, look, if you had gotten in here at, like I said, 7 o'clock, okay, say 7, half 6, say half 6 in this area. Let's say price pushes up to here by say lunchtime, and then obviously pulls back. Then you could obviously monitor again around that New York session and just see how price is reacting. If it continues to retrace and be bullish, well then you can get back in again. But you can see here, look, you would have taken 23 odd pips off of this trade, and you've been done by 10 o'clock, 10 a.m. Like, that is as simple as it gets. You know, obviously depending on how much you have on that trade, depending on what type of risk you have in that trade, whether it's 1 lot, 2 lots, half a lot, whatever the case may be, you could obviously maximize your risk just by using that skill set, using those predictions. You could obviously leverage your capital completely, and it's really that simple. And that's why I'm really trying to hone in on the DXY and its importance the past while, because it really does help to know which way the DXY is going, because then you can capitalize successfully and consistently on this type of stuff. So yeah, I hope you guys have learned from that. I hope you guys can see exactly what I'm trying to talk about as to why price pushed up. And like I said before, no surprise really why price started pushing up and started correlating with that DXY, because again we came to that key level 117 okay, and bounced off of that as a support. You see, price doesn't always either go and bounce straight off of it, because if it did, it would mean that price would bounce off of that key level and move off. The majority of times it'll break through it and then retrace and start pushing back. As you can see, it did there, push down as far as 16,800, 16,850, in and around those levels, and then started retracing back into that London session and started pushing up. So again, like I said, just being disciplined and sticking to that discipline is the challenging part. That is the challenge. And I really encourage you guys to actually test it out and then stick to it. So challenge yourself to, if you're having trouble with consistency and breaking through to profitability, like, ask yourself the questions of, like, do you understand really your trading plan? Because if you don't understand your trading plan, well, then you can't leverage this thing. You can't scale this thing up. You can't, scale this thing up to like trading €1 million funded account or a $500,000 funded account, whatever the case may be. It's just not going to happen. You're not just going to throw anything at this and it's going to just take off. You have to do things that actually work, that are consistently working, like this, what I'm showing you. So if you're having, like I said, difficulty with breaking through to profitability, go back and look at your trading plan and really, really, really just, go in on it. Go in as much as you can and just continue to invest that time and effort into figuring it all out. And once you figure it all out, things become a lot way clearer. And then when things become clearer, you're still going to have challenges. You're going to have the challenge of, being disciplined. Being disciplined, because price may be at a key level, for example, 117, but it may be at a time when you're not supposed to trade, like 9 p.m., 10 p.m. at night, when you're not supposed to trade. When it's like the Tokyo session or the Asian session, when you're not supposed to trade. But if you go back, if you just look historically, go back test and see what works and what doesn't work, well then, you're laughing. You're literally laughing. You can see then, okay, this works, this doesn't work. I can see, right, this is what works. Now the challenge is just being disciplined to stick to that on the times when you're not trading, when you're just sitting back and you're not trading, when when you want to trade, but it's outside of your window to trade. Like I said, if it's the Asian session, it's outside of your window to trade, so stay away from it. Don't even look at it. Just come off the charts completely and then come back to the charts then when it's your time to trade. Hope that makes sense. I really do, because once you, like I said, can catch on to it, then you can start capitalizing on what way the market is going to go, and then you'll start seeing those profits rolling in. So hope you enjoyed this video, guys. I hope you've taken some value away from it. Like I said, go back, look at the DXY, plot on those key levels, 95, 94.500, 9500, 95, 95.500, etc., and then correlate that with those key pairs and see for yourself what I'm talking about, what way the price moves and the key times that they're likely move, which is the London session and the New York session. So I hope you found some value, guys. Let us know if you did. Leave us a comment. Let us know what you think. Do you already implement this into your trading, and have you found this to work out in your favor yourself? And yeah, let us know, guys. And also smash that like button and let us know if you found some value. So I wish you all the best and hope you have a great day ahead. See you all soon. Peace.